One of my favorite quotes is, if you fail to prepare, you prepare to fail. And I promise you, that is why, or that is one of the reasons why a lot of people do lose money trading stocks. Hi guys, welcome back to my channel. If you guys are new here, my name is Mel, and this is the channel where we're talking about money mindset, wealth management, stock investing / trading. I hope you guys didn't miss my last video, and if you did, I'm gonna go ahead and link it in the description box. The video that I posted the last time was more about longer term investing, whereas this video is about trading or short term investing. Some people like to call it short term investing. And by long term, I mean a year longer, and shorter term, I mean less than a year. So this is a video about preparing for the stock market or preparing to trade in the stock market. One of my favorite quotes is, if you fail to prepare, you prepare to fail. And I promise you, that is why, or that is one of the reasons why a lot of people do lose money trading stocks. Quick disclaimer though, I'm not a financial advisor. Nope. This is just for educational purposes only. So if you're seeking financial advice, I do encourage you to seek a financial advisor. So with all that being said, let's go ahead and get into the video. All right, so first off, what is the stock market? So the stock market is a platform where you have companies who were once private. They wanted to raise more capital, or they wanted to raise more money. So they put their company on the public market, and they put out shares in hopes that investors like you and I or institutions would buy into their company, and their hope is for them to expand and grow their company, right? So let's get into some of the stock terminology that is associated with trading that you should be familiar with, or you should become familiar with before you really get into trading, okay? So stock terminology. So when you hear the word bullish, think about a person who thinks that the underlying stock is going to go up in the future. So bullish means that they think that the market is going to go up. If you hear someone say the word bearish, it is the opposite. A bear is a person who thinks that the stock market maybe is overvalued and that it may go down in the future. The next thing I want to point out is the ticker symbol, and I mentioned this in the last video, but a ticker symbol is the abbreviation for the company. So for example, I know like all of you used Instagram and probably Facebook. Well, Meta is the owner of both Facebook and Instagram. Meta, which is META, the company, their ticker symbol is also META. So think of the ticker symbol as the abbreviation for the company, because you're gonna need to know that when it comes to making your watch list, which we'll talk about later. If you hear someone say going long means that they bought a stock, say for example, at $100 because they think that the price is gonna go up. So when you buy a stock, you're going long, okay? So just say if Apple's price is at $100 today, which is not, I'm just using it as an example, but if Apple's price was at $100 today, if I buy the stock in hopes that the stock is gonna go up, I am said to be going long in the stock. Going short is the opposite of going long. So we won't talk about short selling in this video in depth because short selling is a more advanced concept, but I know like when you heard about the GameStop situation, for example, there was something that happened called a short squeeze. So going short is basically you have investors who think the market is gonna go down, so they sell the shares in hopes to buy it to cover or buy it back at a lower price. And I know that may sound kind of crazy right now. We won't talk about it in depth, but I'm just giving you an idea of what it means to be going short. And the last thing I'm gonna mention is something that's really important, because a lot of people I found out didn't even know this was a thing, but a stock market order. So a stock market order is something to get familiar with. Some people will tell you to not use a stock market order. Honestly, I feel like that is the craziest thing ever, because this is how you mitigate your risk in the stock market, not the stock market, the stock market. So a stock market order is basically if, just say for example, you bought Apple stock at $100, and if you only wanted to risk $5, just say for example, you would then put your stock market order at $95. So then it will take you completely out of the stock at $95 and you only lost $5, okay? So that's some of the stock terminology. The next thing I want to discuss is the brokerage. So, you know, once you kind of learn some of the terminology, and the words that I just went over were just some of the basic words. There is much more that goes into stock terminology, and we'll talk about that in later videos, but this is once again for beginners. Once you kind of had a concept of what the terminology is, then you will want to look to see about finding a brokerage to trade. So I mentioned in long-term investing that, you know, I gave you a list of brokerages that you could use to invest your money. When it comes to trading, trading is a little bit different. So the brokerage is going to be a little bit different than it would be for investing. Now, some people do trade on platforms like Robinhood as well, invest on Robinhood, but I personally, for example, I have my investments or my longer term stocks that I'm holding for years on Fidelity, but I trade on companies like TradeStation. The platform is made specifically for traders. Once again, that may sound crazy to you because you're trying to figure out why. I will explain to you later on. So as far as your brokerages, these are some of the brokerages that are designed for traders. You have companies like TradeStation, you have Thinkorswim, you have Interactive Brokers, and you have Webull. Once again, I personally use TradeStation. This is what I learned on, and this is what has worked for me. I do know people who use Thinkorswim as well, and they love Thinkorswim. So go ahead, stop, pause this video if you need to, and write down the brokerages that you may decide to use. So once you've selected your brokerage, then you want to go into your brokerage platform and you want to create a watch list. And by creating a watch list, or how you create a watch list, once you have your platform set up, you would go to the top and you will type in the ticker symbols. And remember, I mentioned that in the beginning of the video, which are the abbreviations for the stock. You're going to want to know the ticker symbol. But if you are just, you know, interested, looking at this video and you're like, oh, I want to see how to set up a watch list and I want to see what it's all about, you don't necessarily have to set up your brokerage first to create a watch list. You can do it on platforms like Yahoo Finance. And this is what I did. And the reason why especially I like Yahoo Finance to create watch lists, because if you go on there and you create a watch list, it will give you news alerts about a stock. And I don't trade news, but sometimes the news can dictate whether your stock could go up or it can go down. So I like to be in the know about my stocks. The watch list that I create, I trade mega cap companies, large companies like, you know, Nvidia, Meta, Apple, Google. And there's a method to why I do that. I don't trade penny stocks. That's just me. I like to have a lot of liquidity. And liquidity just basically means that you want to make sure you have a lot of people in there that's exchanging hands that are trading stocks. Because, for example, just say if you are trying to trade a stock, but only 10,000 people are trading, and you try to buy the stock, it's a good chance that your order may or may not get filled. So I always trade stocks with a volume of at least 1 million or greater, okay? So I trade mega cap stocks. But you want to go on to Yahoo Finance in the meantime while you're waiting to have your brokerage account set up, and create a watch list and get to know your stocks, make sure they're in an uptrend. And how I did this when I first got started, before I really learned how to read charts, is I would go into Yahoo Finance and I would select the stocks that I was looking for, and I would see, you know, is the percentage of the stock going up for the past year, 6 months, 3 months, or even in the past week, depending on how I'm trying to trade the stock. So yeah, definitely create a watch list. It's super important. So one term you need to get familiar with is the term technical analysis. And a simple definition of what technical analysis is, it's a discipline in stock trading that gathers historical data to help identify trading opportunities. So get used to candlesticks. So a candlestick chart, and this is basically what technical analysis is. You're looking at candlesticks, you're trying to see where, you know, where you get in, and you're looking at price action, you're trying to see where to get out. I'm going to give you a basic overview of candlesticks. We're not going to go into detail. I'm not going to really show you today on how I trade, but I will explain the concept of the candlestick to you. So usually if you're looking at a chart, you'll either see a green or you'll see a red candle. So the green candle just basically means that the price of the stock closed that day at a higher price than it opened. So let's just say, for example, on Apple, we'll use the Apple example again. So let's just say Apple stock for that morning, the stock market, by the way, is open from 8:30 a.m. to 3 o'clock p.m. Central Time. I am in Alabama, so that's the time that the stock market is open for me. But let's just say at 8:30 in the morning, Apple stock opened at $95, okay? So if Apple stock opened at $95 and it went up that day and it closed at $100, that means that the candlestick would be green, because when the market closed that day, the stock ended at a higher price. On the opposite end of that, if you see a red candlestick, let's just say at 8:30 that morning, Apple's price opened at $100, but then at 3 o'clock, when the price closed at 95. So that means that the candle would be red. The wicks that you see on the candles, that's just giving you the highs and the lows of the day, okay? And that's just simply what it is. So get familiar with candlesticks, study candlesticks, and let's roll over into the uptrends and the downtrends. So one thing that I like to say is the trend is your friend. If any of my friends know me, they know I say that all the time. The trend is definitely your friend. So with that being said, when I trade, if I am trying to go long in a stock, meaning that I am buying a stock with the hopes that the price is going to go up, if I see that the trend is down, meaning that, there's lower lows and there's lower highs, I more than likely probably won't try to go long, because the trend is not on my side in that situation. Conversely, if I see a stock that has higher highs, higher lows, and I want to make money or go long, well, the trend is my friend in this situation. So I am more likely to make money on that stock if the stock is in an uptrend. So once again, you know how I told you, if you go to Yahoo Finance, you see the 1 year, the 6 month, the 3 month. If you see that it's consistently going up, well, that kind of tells you, without knowing how to read candlesticks yet, that the stock is somewhat of an uptrend, okay? And the same on the opposite end. If you click the 3 month, the 6 month, the 1 year, and you see that it's constantly red, red, well, the stock is more than likely in a downtrend. The next thing I want to talk about is paper trading. So paper trading is just that you're trading with fake money. It's not real. You can do these on the brokerages that I mentioned earlier. One of the pros, or some of the pros of paper trading, you get to learn your brokerage, you get to learn your stocks, you're not risking real money, and it gives you the opportunity to practice a new strategy before actually implementing it live on your live account where you're using your real money. The only downside of paper trading, I would say, is there's no emotion involved. And the reason why I say that is because you need to build your psychology when it comes to trading. So by psychology, I mean, are you fearful? Are you greedy? I know you've heard people say FOMO. I promise you it's a real thing. Are you the type of person who, if you lose something, you're like, oh, I'm going to get revenge and I'm going to trade and I'm going to get my money back? That's how a lot of people lose their money. Their psychology is totally off. For me, I would say trade psychology is like half of trading. You can know a concept, you can go into the day with a plan and try to thinking you're going to conquer the day, but I promise you, if your psychology is not right, you put yourself at risk of losing money, okay? So that will be the only downside of paper trading. And speaking of going live, you can have a cash account, or you can have something called a margin account. So on a cash account, it's just that you're trading with whatever money you put on. So if you put $2,000 in on the platform to trade, you're going to be able to risk $2,000 versus a margin account. So it depends on the platform, but for example, I use TradeStation. I want to say Thinkorswim is the same. Most platforms give you 2 times your money to hold a trade overnight, meaning that you could, hold that trade on Tuesday, Wednesday, Thursday, and so on. Or they give you 4 times your money to day trade, meaning that you have to get in and out of that trade in the same day to not get something called a margin call. So with a margin account, most platforms require you to deposit at least $2,000 to do it. But with a cash account, you can put however much you want to. There's no limit. But I will say most platforms do require you to deposit up to $2,000 to be able to trade with margin, okay? So statistically, they say 95% of people lose money trading, and there are a couple of reasons why. Usually it's because of an inconsistent trading plan. They have poor risk management, or how I mentioned about trading psychology, they're letting their emotions dictate their trades, and they're not being strategic about their tradings. Poor risk management. So for example, when I trade 3-to-1 risk reward to risk. So if I am risking $100, I better be at least making $300 or more. Poor risk management would be you are risking $1,000 to make $100. That is very poor risk management, and that's how a lot of people do something called blow up their account. Okay, so my goal with this channel is to help you build the knowledge that's necessary to trade and trade responsibly, so you don't blow up your account. Okay, so I hope you guys enjoyed this video. If you like this video, go ahead and hit the like button, subscribe button, share this with a friend. This is once again a very beginner video about trading. I just wanted to give you an overall concept of what it is, how to kind of prepare for it. We will talk about strategies in the future, and I will go into a little bit more detail in the future as well. Okay, thank you guys for watching. Once again, like, subscribe, and yeah.